The 9 deadly sins that will destroy your trading. They've caused me cumulatively over 50,000 in losses or missed opportunities. Here's a breakdown of each one so you can avoid them. I'm Manir, also known as Ghost Talk Trades on Twitter, and also run Unbiased Trading, an agency where we can backtest or automate your strategies. Now, number one is data snooping. For how great it can feel to see an amazing backtest, it feels even better for it to work on live markets. Don't overrun optimizations to find the best historical results. Test your strategies historically, but use your historical data sparingly. So what this basically means when you're using data snooping is if you're overfitting or especially in the context of like running machine learning, for example, but for simplicity, at least for this example, it's mainly if you're over optimizing it. So let's say you're running, 50 optimizations over the same historical data, and then you're also testing over that same data, and you have no out of sample data, then that is 100% just going to lead to overfitting. Now, if you're wondering what overfitting is it's if you over optimize. So if you fit your strategy too closely to historical data where it doesn't work on general or out of sample data. So if I was, if I had 5 years of data, overfitting would be if I run all optimizations just over that 5 years of data and I don't split that data at all to have like in sample, which would be data you can optimize over, and out of sample, which is data that you would test those parameter values from your in sample on the out of sample data. So you can kind of see here on like the robustness scale and then model complexity and then accuracy. If you have really low model complexity, then you probably have very high robustness, but your accuracy is probably going to be decently low as well. If you have that kind of middle line is where you're trying to aim for, where you're having that bias trade-off and the robustness / accuracy trade-off, right? But if you had super high model complexity, then your robustness is going to be probably quite low, and the accuracy might be high, but it also probably will drop off because when you're actually testing on live, then it will drop off. Now, number two is strategy hopping. Abandoning strategies at the first sign of underperformance to chase the latest hot approach is an easy trap to fall into. You need to give strategies time and gather enough evidence to make decisions. I will say this is probably one of those things that seems really obvious. It's just very difficult to execute on. A lot of trading, and I would even say in life and especially in business as well, is the sort of things you should be doing. Well, at least once you become aware of them, and then actually executing on that is the difficult part, right? I love the quote. I think. Cliff Asness, I believe, might have said around Warren Buffett, where he said the most impressive thing about Warren Buffett to him wasn't necessarily his performance, was that he was rigorous on his approach for decades, and that's incredibly difficult to do, especially over if you've been trading a strategy, for example. If it stops working or it feels like it stops working for maybe a week or two, you already start getting those doubts in your head. You already start thinking, maybe I should actually try this different thing, or maybe I should deploy something else. Maybe I should stop running this. It just often takes time. You need to give enough time for your strategies, whether that be sample size or even, waiting out a market regime, for example. You can try and have regime filters, but in my opinion, you probably just want to be running multiple strategies that then, some of them benefit from a market of a certain market regime, while others benefit from others, for example. Now, free is ignoring your costs. Commissions, locates, slippage, and platform fees. These all do add up, and you really should be taking each one of these seriously. There is no avoiding these. Most forget to account these accurately in their historical testing, inflating performance, and it can be a costly mistake when taking live. Here's just one of the kind of examples that when I was doing a strategy paper of how that kind of affects it. So you can see here, when you're applying 10% of ATR slippage, that heavily affects performance. Now, is that realistic? Probably not, at least for this particular strategy when I was running it. 10% would be mega extreme. However, you can still see that even adding some percentages will still decrease performance, right? And especially on strategies that have a lot of trades going on or are trading on a liquid market, that slippage can really eat into your profits, especially one to just be focused on as well as trend following. If you have a trend following strategy where you're trying to lose small quite a lot of times and then you have one big winner, if you have a lot of slippage on those small losses that are supposed to be small, at least when you're testing historically, that will often kill a lot of trend following strategies, because if there is slippage on those, then that can really eat into the overall profits from those big winners. So those are just things to really pay attention to, and why it can be very important to know someone or know how to do proper backtesting, because just simply looking at historical charts isn't going to account for all this sort of things. 4 is feature creep. This often comes from continuously adding complexity to account for every market scenario. Fundamentally, this leads to overfitting by trying to improve performance, whether returns or drawdowns. Make sure each extra feature is worth the risk. For this, I'll actually quote from Pedma. He's another awesome trader on Twitter, and I know him personally. He's a great friend. And he kind of mentions around the thing that each feature should kind of fight for its life. You really shouldn't be adding more things to your strategy unless it really has a notable performance increase, because the more you add to that complexity, as we kind of talked about before, the higher chance for that prediction error or for it not to work on like live markets. So each feature really should have its place, and this can show up in many ways. I sometimes go over people's backtests and they'll have like 5 indicators doing fundamentally the same thing. While that might work if you're doing maybe a machine learning or forecasting approach, for example, if you're doing a simple systematic strategy, you don't need 5 indicators doing the exact same sort of operation. You really should try and just find the one that has the biggest impact on your particular strategy and then remove all the rest. And then, there's other ways that this can happen, especially the market scenario one, where I'll see a lot of traders try and create a strategy that fits all market regimes. Fundamentally, that doesn't really make much sense. You should have different strategies that work for different market regimes, and then you have that in a portfolio. When you try and crowd it all into one strategy, at least from my experience, it never works. 5, position sizing. Risk management isn't just about stops, it's about proper position sizing. Newer traders tend to solely focus on entries and exits while not thinking about how much. This leads to severe underutilization or account blowups, normally the latter. Especially when you're newer to trading, I think a lot of trading, or at least YouTube and things like that, really just focus on, hey, you should be entering here, exiting here, and that's like the perfect strategy, or they focus on win rate. But a lot of trading, especially when you become more systematic and even algorithmic, is position sizing and how you manage that position sizing. You can have a strategy that doesn't have the best overall hit rate, but because you size the highest on A+ opportunities, or however you grade that with a systematic kind of formula, that can be an awesome strategy and do super well. You can do like forecasting bets, which means if this particular signal has a higher forecast, you can put higher amounts of capital on it. That's actually quite discussed in Robert Caravere's Systematic Trading and Position Sizing book, I believe. So if you want to read up more on that, you can check out Robert Caravere and look for his books. But yeah, the position sizing can be a huge feature in itself in a strategy, and I think many people just kind of look at position sizing as how much I'm willing to risk. While that is obviously a key part of it, there's a lot more that you can do with it. 6 is the genius trap. Thinking you need to completely original strategies is often not the case. Most successful trading comes from solid execution and minor adaptation of known concepts. Focus on implementing well rather than reinventing the wheel.
Sources of ideas, and I actually written down many of them in the book. So it is very hard to just sit there and just daydream and say, oh, I think that this trade will work, right? It seldom happens that way. Usually it's inspired by what you read. There are many, many academic papers on different trading strategies. There are many, many blog posts on simple trading strategies. Now, so the sources of ideas, many books also, mine as well and others. So the actual, I would say, trick of the trade is not the original idea generation, because there are already thousands of them out there. All you need is to read and listen. Really the trick of trade is how to filter them down.
As Ernest Chan was saying, a lot of these strategies have been known. You're not often going to find a completely original strategy. I'd be very impressed if you can. For the most part, they're all derivatives of certain types of styles, whether that be trend following, mean reversion, arbitrage, etc. So you don't need to reinvent any of these. These can just work. I know that kind of breaks a lot of beliefs around people thinking, well, if they just work, why doesn't everyone do them? Because there's different things around them that make them difficult to execute or manage, or you have to have a slightly original angle on the actual strategy type. That doesn't mean the strategy type is completely new. It means that you have a slightly different approach, or whether that be you're doing it on emerging markets like crypto, etc. That can be the extra edge you're kind of getting from that. 7, not having clear criteria. Discretionary skill can take years to develop, and not all excel at it. For instance, I perform exponentially better using a data-driven approach rather than discretion. Establish clear strategy criteria and then slavishly stick to it. Now, the slavishly quote is from Jim Simons, where he gave a lecture and he said, slavishly just stick to your models. Now, if you are looking to become a bit more systematic for 2025, I've reopened the backtesting bootcamp. Now, the Backtesting Bootcamp is all about teaching you the fundamentals of backtesting and also helping you transform into a more systematic trader. It goes through absolutely everything you need. We have code templates, we have guides on every sort of part of backtesting and systematic trading. Overall, it'll help you build unshakable confidence through data and not gut feelings. If you don't want to be a discretionary trader anymore, and you don't want to just be relying on your intuition, and you want data-backed strategies instead, then I would say this bootcamp is definitely probably worth it for you. It's going to be opening up in late January 31st, but you can purchase a slot now. But also, if you just want some free value, come over to the howtobacktestbootcamp.card.co website. It'll be linked in the description, and you have a free backtester starter kit. It pretty much goes over 3 deadly sins you need to avoid, and then also the starting steps of how you can start backtesting for yourself. You'll get that completely for free just by entering in your email right here, and you'll also get more info on pricing details, launch details, etc. But yeah, if you want in 2025 to become more systematic, this isn't a classic course around promising you 6 figures of trading profits. This is about learning a very valuable skill that's helped me hit 6 figures in profits, and I've seen it help many others. As you can go through on the website, we've had over 100 traders go through it. We pretty much have 100% satisfaction results, at least from our surveys. Feel free to put your name and email here, and you'll get sent an email with that free essentials backtest starter kit. Now, number 8 is impatience. Short-sightedness breeds impatience, which results in rash decisions. I grew my account faster when I accepted it would take years, rather than chasing 5x returns in a week. Such gains often never happen, and if they do, you'll often lose it as fast. This one is a really more psychological side of things, but I found so much of my gains and growth have just come from accepting it will take time. When you feel that sort of compacted energy in yourself where you feel like you need to make this work today, you need to make X profit today, whatever, and that's often when you make the worst decisions, at least from my experience. So having that long-sighted kind of view can really help you moderate your decisions, which will then often lead you taking better decisions that actually get you there faster than if you try to rush it the whole time. Now, 9 is strategies don't last forever. Finding your first profitable strategy can feel like you've completed trading. Unfortunately, alpha decay is real and can happen at any time. To stay ahead, conduct continuous research and develop new strategies to diverse. I see a lot of, especially Forex traders, at least on YouTube, try and sell you this dream of that, hey, they have this one strategy that's worked forever and you can just keep on using it. While, strategies can last a while, they often will need adaptation over time. That doesn't mean they need adaptation next week, but they often will fade over time. And if you want to do trading as a career, whether that be, 5, 10 years, etc., you need to know the skills of how to develop and backtest strategies so that you can continue adding new strategies to your portfolio. And once you've mastered that skill, that allows you to, test out tons of ideas, and you can filter out all the bad ones and then create a portfolio of, solid trading strategies that you can add to and replace over time. And as Jim Simon says, the system is always leaking and we keep having to add water to keep it ahead of the game. Now, if you find this type of content valuable and want more every single week, feel free to follow me on Twitter at GhostOrgTrades, or feel free to subscribe here. And I hope you had a great Christmas, and I hope you have a great rest of your day.